G'day folks, welcome back to another update for our share reviews, and today we're looking at the Magnificent 7 on the US market. Now overall, out of the 7 stocks, 4 are showing bullish momentum according to our scans, and we'll go through each of the stocks and show you how they work, including some back testing. Before we go any further, make sure you hit that like and subscribe button to support the channel. So as of today, May 28, 2025, the market recovery after a $2.12 million trillion loss in early April due to tariff announcements. These tech giants rebounded with a $3.7 trillion market cap gain by mid-May, aided by tariff delays and new trade agreements. Earnings performance: the group is projected to achieve a 12.6% earnings increase on 9.5% higher revenues in 2025, a slowdown from 2024's 40.4% earnings growth. Investor sentiment: active fund managers have reduced exposure to big tech, notably Apple and Nvidia, shifting towards financials and healthcare sectors. Nvidia's anticipated earnings: Nvidia's first quarter earnings are highly anticipated, with analysts forecasting 66% revenue increase to $43.3 billion, despite challenges from US export restrictions to China. Microsoft stability: Microsoft stands out with 18% year-over-year earnings growth, driven by robust cloud services and lower macroeconomic risks. Tesla's prospects: Tesla stock has surged nearly 7% amid optimism over upcoming robotaxi initiative, despite earlier sales declines. So I'll start off with the 4 stocks that are entered into our scan as bullish momentum, so relatively safe for trading, I would say, but again, based on the methodology. So what we look at is the long-term trends. We've got the monthly, the weekly, and the daily. And what criteria used to scan is when the weekly is broken above the moving average range, and the daily and in the weekly it was also above the moving average of the price chart and the CCI, then it's pretty safe to trade on the lower time frame, in this case the daily. So if you're trading on the daily, we always look at the weekly trends. So for example, if you're trading on the weekly time frame, it's not quite ready yet because the monthly is showing a bearish momentum on the CCI, which means you could always fall back. Now, the monthly is showing, I would call it a neutral positioning. The weekly is bullish and the daily is bullish. And the other thing we'll look at as well is any divergence. You can see here we had a bearish divergence versus higher highs on the price versus lower highs on the CCI. And the CCI kept dropping as well, and that broke through our minimum target range. So if I was to show you the Fibonacci retrace on that, we take it back to that low there, to the low before the divergence started, and that's at 38% range. You can see there it broke below the 61%, almost the 100% retrace level. Now the CCI on the weekly is breaking higher, and so is the price, so it's giving us a nice bullish momentum, as I said. On the daily, again, you would have been trading according to this period on the daily on the lower time frames, but again, there was another bearish divergence here. Slightly lower highs on the CCI versus slightly higher highs on the price, and it broke down and hit our minimum target range. And again, if I was to draw a Fibonacci range to show you, that's at 38% range on the daily, and that's independent from the weekly as well. They're not always aligned. So then we go to the intraday chart, and even if you're trading on the daily, we always look at the intraday. So again, bullish momentum on the daily, which means you can only take long trades. Now, we did have a bearish. This is why it's important to look at the 1 hour time frame or the intraday. I think the 1 hour is always a good time frame to look at any divergence. Here we had a bearish divergence on the CCI versus higher highs on the price, and that actually broke down ever so slightly. Not strong really, but I'd like to see this break a lot higher than that previous high on the price, but also I want to see the CCI start rising more strongly as well. This could actually keep falling, so just be careful about going long. I've drawn a target range here, and that target range was initially drawn between that high and that low. Now that's a bit ambitious, because what I'd like to do is I'd like to take it back to the previous low before that divergence started. Now it could have been any one of those spots. So you can see there I drew it on that one. But if you drew it on that one, you can see there that candle just touched that 23% range. So it's a bit subjective where you draw these Fibonacci's. I like to take it back to a significant low, and for me, that low there was quite significant, so just be cautious of this. I'd like to see this CCI break and a lot higher and bounce a lot higher from where it is at the moment. In terms of back testing, what we've got here, let me just get rid of this Fibonacci. So I started the back test on the stop loss approach and the average down approach, and they both started back testing from that point there when the CCI broke on the daily. This is the 1 hour time frame. So if you had it stayed in the trade until where we are today, the stop loss approach has generated $36, and that's trading $1,000 lots. So these bars represent a trade in and out. Had a bit of a drawdown here below the $100,000 baseline. That's for the stop loss approach versus the average down approach. You average down a few times there. Notice the drawdown was a lot stronger, but when the recovery came, the total result was $407 with $1,000 lots traded each time, and you double your averaging down each entry. And you would have ideally closed out your positions when the CCI on the daily broke down into that moving average range, which is about this area here. So you would have closed it out and then re-entered the trades back when it broke above in the last day of trade there. Next, we'll look at Tesla, another of the stocks that actually is broken into our bullish momentum. On the monthly, it's broken above the moving average band on the price, and it's just about to freshly break out on the monthly CCI as well. So that's quite strong for Tesla on the monthly. On the weekly, that's qualified it for our bullish scan. It's broken above the CCI moving average and also the price. So bullish momentum there. By the way, there's no divergence that I can see on the monthly and the weekly. They happen more often on the 1 hour time frame. On the daily, we did have sort of flatlined here for a while, then it finally broken up, and here it's broken up quite strongly on the price, and also the CCI had a couple of retraces, but currently also bullish on the CCI in the last day of trade, and taking long positions on the smaller time frame or even on the daily. If we go to the intraday time frame, first let me show you the 1 hour time frame here in terms of any divergence. I'm not going to qualify that as a divergence because that high there is higher than that, so I'm going to ignore that. But you'll notice here, if you look carefully, between that high and that high, it's rising ever so slightly. In fact, you could probably extend it up to that point versus the same period to that point there on the CCI. That's a bearish divergence. Now again, let's just see, we'll take it back to this area. Let's see if that actually, you can see that if you took it back to that level there, that 23-38% range was penetrated. So that executed. Now again, I'd like to see this continue to rise on the CCI on the 1 hour, and in which case we'll see the price rise as well. So it looks like it's already hit that divergence. I don't trade these divergences. I always use them in an area to get out of long positions. So if you're trading this going long, you probably would have taken your profits and waited for this to break above higher there as well. Now in this case, it wouldn't have made a big difference, but sometimes they can break a lot. The price can break a lot lower. Now if we go to the back testing on the stop loss approach, had you remain in hold, again, the back testing started back here when the CCI broke above the moving average range there, and so did the price. The stop loss approach generated $137 with $1,000 lot of shares traded, and the average down approach, you averaged down a few times there, generated $736. Another stock that's showing up in the bullish scans is Microsoft. So on the monthly, very strongly bullish above the moving average band of the price chart, although notice the CCI is still somewhat bearish, if you will, neutral at the moment, and that was after this bearish divergence, lower highs in the CCI versus higher highs in the price. There are a couple of bearish divergences here, very long-term one here, after a meteoric rise for Microsoft, broke down into that moving average range. So again, just to demonstrate these ones, let me just blow that up. So if we draw that on the first one there, that was a pullback, and that was to that low there. Again, just take it back to a significant low. That's where the first sort of little dip happens. And you can see there it hit that 23-38% range. And if we took that, if we took that to that new high there, and we extended this, where did I take this one? That was back to that low there. Then that 23-38% range, that would have been a bit low actually, about there. That's also hit its target range. Again, that's on the monthly. Just they don't always break strongly down. Sometimes they just bounce into that range and then bounce up from there again. So that's on the monthly. On the weekly, we had another bearish divergence there, hit our target range, and that would have been down to Fibonacci, down to that range. Broke down to about, you can see almost to the 50%, actually on a 50% level, and bounced and broke through that 23-38% range, touched in it, then it bounced out of it, and it finally broke lower, but that actually completed its divergence in that little bounce there. But you'll notice here on the CCI, it's broken above the moving average band on the CCI, but also the price. So that's a nice bullish move. Notice here as well we've got a fair value gap, and what that fair value gap defined is where that previous candle there went as high as that point there, and the candle after that big candle there broke went as low as that point, and that grey area you see there is called a fair value gap. So we expect at some point in the near future to break down into that area. So just be careful about going long or putting too much into Microsoft. We might see a bit of a pullback. You can see there another little fair value gap there. There's a bearish one there. All it needs to do is break, even with a wick, break into those fair value gap zones to pick up any unfilled orders. On the daily, so bullish on the weekly. On the daily, again, another fair value gap there. So we might expect it to pull back. Notice as well, if I zoom in, even though it's showing bullish momentum on the price and the CCI above the moving averages, we do have a, if you look so closely, and these narrow divergence are more volatile usually. Now, assuming when a market opens, if this breaks high, if the price breaks high, and it could well do, and hit this resistance, the resistance up here is at 467.60, which will equal that touch point there. But it could actually keep rising. As long as that CCI keeps dropping, we're going to consider that a bearish divergence. And if that happens, then possibly expect it to come down, possibly to, and the wick at least, to come down into this area. So just be careful of going too strongly bullish. Now, on the daily, assuming it starts pulling back from where it is at the moment, but like I said, it could keep rising, but assuming it pulls back from there, I would draw a Fibonacci back to that level. So it could go anywhere from there, that point. Let me just draw it. Again, depends where you draw the Fibonacci. Could go anywhere from there down to there, or even, and you can see there it's touched that. That's a 38% range. But if I delete that Fibonacci, you can see there it's broken into that fair value gap range. So just be cautious of going too strongly bullish. I'd like to see this divergence play out before going long on Microsoft. Now, if we go to the intraday chart, we look at the 1 hour chart. Notice here as well, we've got a bearish divergence. So even though the CCI and the price are broken above their respective moving averages, it hasn't actually broken down enough, in my view, to warrant a continuation. We may see a pullback any time. So if I just draw a Fibonacci, again similar to the daily, this one, you could take it back to that level. So again, I'd draw another range there between that 23% and take it back to that level. So that'll be the range we can expect it to hit as a minimum if this starts pulling back from where it is at the moment. But like I said, it could keep rising. So long as that price is rising and that CCI keeps dropping, we're going to consider that a bearish divergence. Now, in terms of back testing, again, similar to the other stocks we looked at, we start back here around the 23rd of April based on the daily. This is the 1 hour back test, the stop loss approach, and the average down approach. Ideally, you would have closed out your position when the daily here broke into that moving average range, which happened to be at that point there on both the stop loss and the average. So you would have avoided this drawdown on the average down approach. And at that point, the stop loss approach has generated $33 and the average down approach has generated $84 with $1,000 trades. So the last stock that's come up on our bullish scans is Meta. And on the monthly, bullish momentum on the price chart, well above its moving averages. There's no CCI drawn on it for the moment. On the weekly, another bullish momentum on the price and also a fresh breakout on the CCI. So that's a qualification into the bullish scan, and likewise the daily, it's a fresh breakout to the upside on the CCI, and it's also above the moving average of the price chart. There were a couple of, this divergence back here. There was a bearish divergence back here, that little one that hit our target. There was a secondary divergence, I know last time I analysed this, on the CCI was dropping, but notice the price kept rising and the CCI eventually corrected itself and it went higher, so that was no longer a bearish divergence. So we've got to stick to the rules, so we'll delete that, invalidate it. That's why I don't trade these. You've got to wait for the right moment to get in. You could argue that was a double top, but just to be strict with the rules, I like to see this slightly lower, and that is slightly higher. So bullish momentum on the weekly and bullish movement on the daily. going to the intraday chart, again looking at the hourly first nakedly. So again, what we look for is any divergence first. At the moment, you'll notice it's bullish on the CCI and bullish also on the price chart. And we look for any divergence which may help or give us a sort of an idea when to get in or out. Here we're looking at a bearish divergence. So if you're going long during this period and you still held the stock at this point and you saw this micro level of bearishness on the 1 hour chart, you probably want to take your money off the table. So at that point, once you see the price starting declining and especially falling below the moving average range, and you start seeing a new peak on the CCI, that's a start of a bearish divergence in this case. Now if we go to the back test, that also starts back here around about the 23rd of April. The stop loss approach and the average down approach, again taking note of this bearish divergence, but had you let it run through the whole period, and you'll notice here the stop loss approach is breaking even with our $100,000 baseline, and the average down approach is generated $411 based on $1,000 lot entries. Okay, now we'll look at the 3 stocks that didn't qualify as far as bullish momentum goes. This is Google or Alphabet. On the monthly, the price is above the moving averages. Notice the CCI is below the moving averages, giving us a somewhat neutral positioning, and that's a result of this bearish divergence. So higher highs on the price versus lower highs on the CCI. Now, in terms of where I haven't drawn a target for that, let me just do one now. We take it back to that low there. We'll take it back to that low there. So if we were to draw a retrace on that, you can see there it's already broken through that 23-38% retrace level with those 3 months of candles. So it's already hit those targets. On the weekly, had another bearish divergence, and you can see there that's already hit its target as well, but making some recovery. Now the reason this hasn't qualified as a bullish share scanned yet is because even though the daily is bullish, both the price and the CCI above the moving averages, the CCI on the weekly is, but not on the price chart. That's making progress, and if we see that break above the moving average band on the weekly, then we'll consider that a bullish scan as well. We just want to give it some time to breathe and mature, and that's why I'd like to make sure these 2 moving averages are covered in both the weekly and the daily, but also the moving averages on the price and the CCI. So again, bullish momentum on the daily as well, I've mentioned. There's no divergence that I can see. This one was the last one we saw on the weekly. There was also a bearish divergence here on the daily. I'll draw that again. It is there between those peaks, and that eventually fell off well below 100% retrace, and I shouldn't have to draw the Fibonacci to see that. In fact, I would have drawn the Fibonacci to that level and it would have broken it initially back there. So that's the daily. If we go to the intraday charts, we look at the 1 hour. So again, bullish momentum on the daily, so you can take long trades on the 1 hour. This one, fresh breakout here on the CCI and also the price, so you could possibly go long. Before we take any long positions, we look for any divergence, and again there's that double top on the CCI. You can see that's slightly higher than that point. If I was to draw the line, you can see there's a slight increase in or distance between the 2 peaks versus that period there. I won't draw the line, but I'm not going to use that as a divergence. Just ignore that. Doesn't mean it won't fall off. The price doesn't collapse, but just be careful of that. So again, I'd like to see the CCI keep rising, and at some point the CCI will come back. But again, just be cautiously going along with Google or Alphabet, whatever you want to call it. In terms of the back testing for Google, taking long positions from around the 14th of May, that's where the stop loss approach and the average down approach have started back here. The stop loss approach is starting with 100,000 baseline, started off okay, but then it dropped off, started getting stopped out with those candles dropping significantly each time the trade was made. Compared to the average down approach, you would have averaged down a few times there, and that generated $676 compared to about a $50, $40 loss on the stop loss approach. Then we look at Amazon, which also hasn't qualified our bullish shares, but it's about to if things go positively the next few days. On the monthly, it's above the moving average band of the price chart. Notice the CCI is below the moving average, so giving us somewhat a bearish momentum on the CCI. So cautiously bullish on the monthly only. Also notice as well, I haven't drawn the the trend lines, but we had a bearish divergence there versus the same period. That would have been taken to that level. And again, if I was to draw a Fibonacci on that range first, down to that level, you can see that it broke quite convincingly down to the 61% retrace level. And then if we drew another, notice we had another bearish divergence from that range to that range, lower highs on the CCI there. And again, I would have taken it back on the monthly to that level, and that's already penetrated that 23-38% range. So again, I like to take it back to the previous low before the divergence started. So again, divergence aside, it looks like it's probably corrected that divergence, and as long as we see that CCI rise from there, we should see more rise in the Amazon monthly price. On the weekly, it's broken above the CCI, giving us a bullish movement. The price is still in that moving average range. Notice there we had a fair value gap. That red candle came down and filled that. Had another fair value gap there, came down, bounced out of there. So where these fair value gaps happen, you want to be aware that they can be filled pretty soon thereafter of the candle being shown. On the daily, again, I haven't drawn the divergence on these ones, but you would take it from the peaks on the CCI first. So look at that there, lower highs on the CCI versus the same period back to there, higher highs on the price. And again, if we took the Fibonacci range from that high to, again, being subjective where you put these Fibonacci's, but it doesn't really matter. You can see there it broke pretty low. You take it there. I would have taken it back probably to one of these lower previous lows in one of those areas. But in this case, it broke very convincingly through the 23-38% range and almost to the 100% retrace. So that's on the daily. Now again, notice here we had a fair value gap, came in and touched it and then bounced out of there. On the daily here we had another couple of fair value gaps. It's broken down in there. It's already filled those ranges. But importantly, what we look at in terms of trends, we look at the CCI. It's broken with a fresh breakout above the moving average, and so is the price, a bullish momentum on the daily. Now if we go to the 1 hour time frame, notice here we had a very massive fair value gap, and what did it do? It came back and filled it with these candles here. So it's filled that. So always be aware of these fair value gaps. Another one here came back and filled it. We also look at any divergence now on the 1 hour time frame. There's from that peak there. Again, these narrow divergences are often a lot more volatile than the wider ones. So that declining highs there versus rising highs there, and it's pulled back. And again, if I was to draw a Fibonacci hour time frame between that high, I would take it back to that low. You can see it's filled in the 23-38% range. But even if you took it back there, it's already filled that in as well, the 23-38% range there. So that was mission accomplished for that bearish divergence. Now if we go to the back testing, and the back testing in this case started back here on the 23rd of April based on the daily. So the stop loss approach and the average down. Now the stop loss has lost you a bit of money there, about $30 worth. And the average down, because you've averaged down a few times there, has generated $573. Be very careful about the average down approach. Even though I'm demonstrating it here, you must have deep enough pockets and enough funds in your account to buy more stock. So just be aware of that. Okay, lastly, we look at Apple. Now, on the monthly, it's actually broken down. The price is broken down into the moving average range, giving us a neutral positioning. The CCI is already below that moving average, giving us a bearish momentum. And that was after this, back there when I last updated this, I drew those trend lines. So I will extend that to that level there. And that's still a very long-term bearish divergence on the monthly. Started back in 2020. And it's finally, looks like it's finally breaking to the downside. Now initially you could call that a bearish divergence up to that point where I last drew it. Let me just draw you those 2 points there. So the first bearish divergence happened there because the CCI was dropping off and the price was rising up until that point. And if we took it back to that low there, you can see it's already hit that range the first time, that 23-38% range. It went as low as the 38% range. Let me just draw that in there to mark it. About there. And the second one, if you extended it, even if you took it from that point to that point on the CCI, still higher highs on the price. Again, take the Fibonacci range from that high, take it back to that low. You can see there that's also hit its 23-38%. More than 90% of the time it hits this 23-38% range. Okay, again, I don't trade these. I look at these as potential warning signs either to not trade or not to enter a trade, or if you've got positions in the market, then you take your profits off the table. So that bearish divergence has actually played out a couple of times during those periods on the monthly. On the weekly, we've got another bearish momentum with both the price and the CCIs below the moving averages. And again here we've got another bearish divergence between those peaks. And you can see there, I won't draw the Fibonacci up to that point, almost to the 100% retrace level. There was another bearish divergence back here. I've drawn a target, slightly higher highs on the price versus lower highs on the CCI. Fibonacci back to that level, it hit our target, then it bounced out of there. So bearish momentum at the moment on the weekly. On the daily, it's also bearish on both the price and the CCI, even though it's sort of fluctuating above and below. So don't go long at this point. Looks more bearish at the moment on all time frames. There is no bearish or bullish divergence that I can see at the moment. The last one was back here, almost a double top on the CCI versus higher highs on the price, broke down, and then it bounced out. It went sideways for a while based on the CCI and the price, and it finally broke higher. And if we go to the intraday, the 1 hour time frame, this is a great example to show you about the how to read divergence and how to not trade or trade. So basically, you would have taken long trades during those little peaks if you were trading on the 1 hour, taking those little long trades on the daily when they broke above, and you would have stopped taking trades when they broke below. But as I always say, be aware of divergence. Now I'm going to draw the divergence on this chart first. You can see here, going back to this level here, we had declining CCI. It's a bit hard to read the trend line there. Declining CCIs there versus the same period, rising prices there. And what did it do? Depends where you drew the Fibonacci. If you take it back to that level, you can see it's already broken that 23-38% level. But even to that level, it broke down almost to the 50% retrace. That was the first divergence. And the second one, can you see it? What you do first is you read. It's quite easy to read sometimes once you do it a few times. Declining peaks on the CCI versus rising peaks on the price. And again, you can see that I won't draw the Fibonacci, but it broke to the 100% retrace level. Also notice here, lightly shaded in blue, is the fair value gap, and that came down and filled that quite easily. We've got another fair value gap here, and it rose and filled that as well. But again, I don't trade that necessarily. I just look at them as potential areas to be aware of, to trade or not to trade, or to stop trading. Now, in terms of backtesting, again, using as a good example to how to trade. Now, you'll notice here, I started the backtest here with the stop loss approach and the average down approach, beginning back here around about the 22nd or 23rd of April. Now, you'll notice they're both in the red if you let them run through the whole period. So what you do, you trade in the direction of the daily, obviously. Now, in this case, if you let the CCI break into that moving average range, the first one there on the 1 hour time frame would have been about that point there. But do note as well, this is how I use this, the divergence. As soon as you see these divergence, a bearish divergence, and the price breaks below, like at that point there, that would have been an ideal place to get out of the trade. And if you did that, then the first on the stop loss approach is generated, albeit $5, and the average down approach generated 67. You don't get back in a trade until this point here on the daily, where it breaks above. Now, this might have been a bit too late to get into it, because as you'll notice there, that would have been a false break. And what happened? We didn't know at this point, but the CCI started to decline. The price kept rising. We thought we were in with a good win. Then finally, the CCI broke down, and the price broke down as well. So as well as the daily, you must also look at the hourly, if you're trading the hourly time frame. As soon as you see that price break below the moving average band, you would have been wise to get out of the trade there. Now, the stop loss approach you would have taken a hit of about $40. But if you got out about there on the average down approach, you would have got out with $144. So don't always follow the daily, or also follow divergence on the 1 hour time frame. And as soon as you see a divergence, get out of the trade. That's how I use it. So again, a classic example of how to use divergence. So if you're new to trading, we're now including a weekly video series, Pete's Investing Plus One, as part of the Pete's Investing channel. The Plus One videos are a dumbed down version of our strategies, so if you missed some of the finer details of this video and give you a better insight into our analysis, follow these videos which break it down in a lot more simpler language. And if you enjoy the content and support me, want to subscribe to the Patreon page for a small cost of a cup of coffee. Support the channel, but also help you check for any bullish shares, which some of these ones we looked at today would have come up. Thanks, and talk to you in our next video.